Now that we know how to classify our lease, the next step is to measure and record the opening asset and liability balances. And somewhat ironically, after all the time we spent getting the classification correct, this step is identical for both operating and finance leases. That's actually good news for us because it means we don't need separate processes here. We'll need to split things out later when we get to the ongoing or subsequent accounting. But for initial measurement, we only have one process to learn. Before we dive into the detailed calculations, let's start at a high level. That helps set the stage and highlight a few definitions we need to be comfortable with before we calculate anything. First, we measure and record the lease on the commencement date, which, as we discussed, is the date the lessor makes the asset available for our use. The goal at that point is to record the opening ROU asset and liability balances, and the easiest way to do that is to start with the liability, because the ROU asset we record will include several components, and one of those is the lease liability itself. So we measure the lease liability on the commencement date as the present value of all remaining lease payments, meaning only the payments that occur after the commencement date. Any payments made before commencement are not included in the lease liability. As we'll see in future episodes, they instead affect the right-of-use asset. And we calculate that present value using an appropriate discount rate. So let's break this down. The first thing we need to understand is what makes up our lease payments. ASC 842 goes into a lot of detail on this, and we'll walk through each piece together. After that, we need to look at the discount rate we'll use to calculate the present value. Once we understand those two elements, we'll be ready to calculate the lease liability. So first, what exactly is a lease payment? ASC 842 1035 lays this out clearly and lists 6 different types of payments that are included. Let's walk through each of them. The first type of lease payment is any fixed payments, including in-substance fixed payments, reduced by any lease incentives paid or payable to the lessee. For example, if we lease a warehouse for $2,000 a month, that's a fixed payment. In-substance fixed payments are payments that may look variable but are effectively unavoidable. So if that warehouse lease charges $1 annually per pallet and requires us to store at least 10,000 pallets at all times, that annual charge is essentially a fixed $10,000 payment. The second type of lease payment is any variable lease payment that depends on an index or a rate, like CPI or a market interest rate. And when we initially measure the lease, we use the index or rate that exists on the commencement date. For example, if we lease a piece of equipment for 3 years at $60,000 a year, and those payments adjust each year for changes in the CPI, we still include all 3 payments at $60,000 when we first measure the lease. Any CPI-related adjustments will be handled later, and we'll look at that in detail later in the series. Now, variable payments that do not depend on an index or a rate are not included in lease payments. A common example is a vehicle lease that charges extra for mileage over a set limit. Those overage charges are excluded from the initial measurement. The third type of lease payment is the exercise price of a purchase option, but only if we're reasonably certain we'll exercise that option. For example, if a vehicle lease gives us the option to buy the car at the end of the lease term and we're reasonably certain we'll do so, that purchase price is included in the lease payments. The fourth type of lease payment is any penalty for terminating the lease, but only if the lease term assumes we'll exercise that termination option. Remember, the lease term includes the non-cancelable period, any renewal periods we're reasonably certain to exercise, any termination periods we're reasonably certain not to exercise, and any renewal periods controlled by the lessor. So if we sign a 5-year lease with the option to terminate after 3 years, and we're reasonably certain we'll exercise that option, the lease term becomes 3 years, and any penalty for that early termination is included in the lease payments. The fifth type of lease payment is any fee the lessee pays to a special purpose entity that was created to structure the transaction. This is an edge case, but if the lessor sets up a special purpose entity to own the asset and we agree to contribute to its costs, those payments are included as lease payments. Just note that these fees are not included when determining the fair value of the underlying asset for classification purposes. And finally, for the lessee only, we include any amounts we expect to pay under residual value guarantees. We'll cover residual value guarantees in more detail later, but for a simple example, if we guarantee that a leased asset will be worth $10,000 at the end of the lease, but expect its fair value to be $4,000, we would include the expected $6,000 shortfall as part of the lease payments at commencement. Not the maximum guarantee, only what we actually expect to pay. ASC 842 also tells us what is not considered a lease payment. These include variable payments that aren't tied to an index or a rate, guarantees of the lessor's debt, any amounts allocated to non-lease components, and any leasehold improvements we recognize as the lessee. Notice the pattern here. If a payment doesn't create an unavoidable obligation for the right to use the asset, it generally doesn't belong in lease payments. So that covers everything we include as a lease payment under ASC 842, and this will be a key part of how we calculate the opening asset and liability. And don't worry, we'll walk through plenty of concrete examples later in the series so this all becomes second nature. Before we can calculate the opening liability though, we do need to understand one more important piece of the calculation, the discount rate. That's what we'll cover in the next episode.